Good morning, everyone. Welcome to this global rundown for stocks and commodities, and of course the start of the 2019 year. What a ride it's been since October, where we started the correction, had a little bit of a lull in relative terms in November, and then December was just horrid, the worst December since 1929. I've covered partially some of the reasons behind this. Some of them are fairly obvious, some of them not so. But the important thing is, where do we go from here? And the answer in a nutshell is, I think I would defy anybody to have confidence in what lies ahead, other than the fact that it's probably going to be pretty volatile. But the short-term direction is extremely difficult to pick, if not impossible, because it's being driven by news events, and it's just a very, very difficult environment. But inevitably, when people get a bit scared, they sell off unreasonably and emotionally, and that creates terrific opportunities, because the whole world's economic system isn't about to collapse, and some of the best companies in the world are not about to slow down in their growth trajectory. So there are terrific opportunities out there, and we can now buy stocks that for the last 3 or 4 years have been at probably an overvalued level, and now we can buy them at an undervalued level. So there's certainly opportunity out there, and that's what I'll be trying to focus on and give you a perspective to uncover those opportunities throughout 2019. So let's get on with it. In this update, the basic concept, I think, is if it's news, if people know about it, then it's already in the share price. So you can just forget about reading something and then trying to cash in on it. It's by the time that it's actually being talked about in the media, then it's already well and truly in the share price. And we're seeing this current global slowdown, particularly in Europe, and to a degree in China and Japan, and that was really what the market was starting to price in October, and it really took several months for that. For those data points to actually emerge. So I'm going to give you a perspective as best as I see it on markets at the moment, and also most valuably where the lower risk opportunities are emerging in the market. There'll be just a normal update on stocks and commodities, and of course we had a short break from Portfolio Analyst. Now, American stocks, the index actually ended up by 1.6% on the week, but most of that, if not all of that recovery occurred on Friday. It was a very big session. So what we had was downside in the early part of the week, and that was due to the data coming out of China, which really worried people. And then also, of course, the not to be understated announcement from Apple that they were actually winding back their sales growth. That's never happened before, and it was a big event. No mistake about it. This has huge ramifications for Apple and for their suppliers, and perhaps it's a pointer to some things that people thought were pretty much unchallengeable, and that's that the growth in iPhones would just continue to go on, and that's sort of really been shaken a fair bit. So the early part of the week was dominated by negatives, and then on Friday, of course, the Fed came out and said, look, they're going to be patient in terms of future rate rises, and they're also going to be data driven, and that was just the news that the market wanted to hear, and there was a very strong rally on Friday as a consequence. But I think it's safe to say that the consensus view, right or wrong, but so far it looks as though it's heading in the right direction. The consensus view is that we are going to see a significant economic slowdown around the world, and we're already seeing that in Europe, and to a lesser degree in China, and perhaps finding its way into America as well. So I think that's a reasonable assumption to make. But that doesn't mean that the economy stops growing. It just means that it's growing at a slower rate than it was. And so so earnings projections are now being questioned. And I'm talking in the States here. So inevitably, those earnings projections, people will become too negative. People don't tend to be in the middle, fairly neutral in outlook. They either tend to be enormously bullish or enormously bearish. And what we're seeing now is the consensus view has turned enormously bearish. And so the earnings projections, which is, of course, driving the share prices, are being wound right back. And they'll probably be wound back too far, which means share prices will come back too far. And that's what creates the opportunity. So it all adds up, to my mind, to a loss of confidence. That's really what's happened over the last 3 to 6 months. The majority of people have now lost confidence in the growth story in America. Over the last few weeks, the enormous volatility spike that we've seen has been driven by news, by rumours, and it's of course been flown by the algorithms. And we saw plenty of that over the Christmas, just pre-Christmas and the Christmas New Year period, and certainly in currencies we saw some staggering volatility through the week just gone. So the algorithms are really cashing in on the fact that we've got somewhat limited liquidity at the moment with all the holidays, and hence we've got enormous volatility. Emotion is winning. People are panicking, and that always spells opportunity. So now's the time to be looking for opportunities, not pulling the bed covers over your head. And there's some tremendous opportunities that are there on the table now. The US dollar ended up slightly lower on the week, and that was really because people are winding back their expectations on what the Fed will do with the interest rate program. But we did see massive global volatility that started last Wednesday in Asia. And I recall I had a platform open that had live streaming Australian dollar currency, and the Australian dollar dropped from 70.5 to 67.5 in the space of about 5 minutes, and then recovered to about 69.5. But I've never seen currency movement that large in such a short period of time. It was quite staggering. So that just shows you the impact that algorithms can have. Also, in America, the 10-year Treasury yield, just think back 3 or 4 months, it had broken above 3%, got up to 3.25%, and everybody just assumed that it would just zip its way up to 4%, and that was why we started getting some panic selling in the stock market. Wind forward 3 months, and we're now back down to 2.67. It's been such a staggering turnaround. I think 99% of people on the planet would have said that 3.25 would have been, going forward 3 months, that 3.25 would have been as low as you could expect, and that it would be somewhat higher than that. And here we are, nearly 0.5% lower. It's quite an amazing turnaround. So let's jump in and take a look at the US stocks. So this is the S&P. So here was our February swing low. So that was the line in the sand that I didn't want to see broken, and you can see that it got absolutely smashed in the week leading up to Christmas. We then had another swing low that occurred in October. So whether you take the February one or the October one, they were all taken out, and they were taken out without a pause. Very emphatic down move in the S&P, and we peaked out at about 29.40, and we've temporarily bottomed out at 23.40. So a 600-point decline on the S&P. So normally that's the sort of thing that I look for to guide my exposure levels, and certainly wound my exposure levels back way up here somewhere, as members will know, and also when we got a break here, then put in place some hedging as well. Now, the question is where to from here? Just before I go there, let's just look at 2015-16. So in 2015-16, you can see the initial breakdown occurred. The market, for a start, the market was trading much, much closer to the 200-day moving average, which is the red line. And then we got a breakdown in August 2015. We then got a recovery to slightly lower highs, and then we broke those swing lows in January and February. But you can see each of those swing low breaks were very, very brief. They're only a couple of days, and then the market was back off again. But you will notice that the blue 50-day moving average line came down below the 200. The 200 had rolled over, and the price was well below that. So just bear that picture in mind. Now let's wind forward to today. 200-day moving average really just rolled over. The 50's cut it. But the difference this time is that we've got a much deeper and a much more emphatic break. So therefore, you'd be nuts if you didn't have at least the possibility that the 10-year bull market is finished. You just have to factor that in as being a possibility. Now, I'm still not writing off the chance that this is a rerun of 2015-16 and that we will eventually, whenever that is, we will eventually push on to new highs sometime later this year in the S&P. But this has weakened that case considerably. And so therefore, I'm very open-minded about where the S&P goes. Now, this plunge was driven by fear and emotion. We then got a few days of recovery from just grossly oversold, which is always going to happen. We then got a sharp sell-off on Thursday, which was really a result of China and Apple. And then we got an amazing turnaround on Friday as a result of some Fed commentary. So it all adds up to the fact that short term, it's impossible to know where the market is going to go on a day-by-day basis. Absolutely impossible. So, don't even try and go there because it'll just cost you money. You've just got to have a methodology that's going to stand up to this sort of market action and have confidence in what you're doing. So we'll just, for me, this will just be a week-by-week determination, just looking at the price action and trying to assign some probabilities from that price action and resist the urge to try and form an opinion about where the market's going. So that's the S&P. Just while I'm here, let's look at the US dollar index. Not a lot of movement. You can see we're generally in a medium to long-term uptrend. Short term, we've been tracking down a little bit over the last couple of weeks. Now, the Australian dollar did dip under 70 cents, so we actually had a couple of days where we closed, Wednesday and Thursday, we closed below 70 cents, which is the first time that had happened since 2016. So again, there's a lot of similarities with that period in early 2016, but we did have quite a strong rebound on Friday, and I'm not quite sure why that rebound was quite so strong. But anyway, I'm sure that will become more evident in time. So that's the outlook on the US. So the Australian dollar, we actually ended up a little bit higher, but all that work got done on Friday. And the ASX 200 was down by 35 on the week, 0.6%. But we should see a rebound on Monday following Wall Street. But like I've never seen it before, the Australian stocks are really trading very much as stocks on their own merit, or the market perception of their merit. We're not getting a situation where stocks in certain sectors are all rising together. Each stock seems to be moving very much to its own tune, to a greater extent than I've ever seen before. So this is very, very much a stock picker's market in Australia. Precious metals, gold was up since the last time I reported in just before Christmas. It's gained another $27. Remember, you might recall there was a resistance level at 12.45 that we needed to break. Well, we've easily broken that in gold, and we got up to 12.85 at the finish. But intra-week, the gold price did actually hit around 12.97 at one stage. So certainly gold is in uptrend. And this is really about more perceived risk on all sorts of levels. And the things that'll get gold price moving is if it's perceived that the Fed's interest rate rising cycle is now done and dusted for a while, which I think is just a distinct possibility. So that's good for gold. More perceived risk and panic is good for gold. And of course, a lower US dollar, which will result from the Fed not raising rates in 2019. That's also good for gold. So we've got a number of things that are positive for the gold price. As far as precious metal stocks go, stocks are on the improve. The best performing gold stocks in the world are Australian gold producers, and that has been the case for the last probably year to 18 months, and that's partially helped by the weaker Australian dollar. But certainly GDX is starting to look a little bit better. So let's take a look at GDX now. So this is on a weekly chart. Still nothing to get really excited about. We've moved from around 18.5 to around 21.5, but it's now heading in the right direction. And if we look at the gold price, that's the gold price on a daily chart. So you can see we clearly broke this 12.45 level. We're clearly an uptrend, and if we look at it on a weekly chart, you can see it a bit more clearly. The next major line in the sand is up here around 1380. So, and that would also represent, if we wind back and take a really big picture look. So this is the peak in gold in 2011. This is the bottom, and so this level here around 1380 is the first major Fibonacci retracement level of this whole big picture. So we went up to it, we pulled back, we ran up to it again in 2018, pulled back, and now we're having another go at it. If it can break through 1380, then I think you'll see gold move on to challenge these higher levels towards $1,500 and $1,600 an ounce. And if the Australian dollar remains where it is around the 70-cent level, then that is just going to do amazing things for the profitability of Australian gold producers. And I stress producers. There's still a lot of risk around the explorers and developers. So if you're going to go into the gold sector in Australia, I would very much stick to the lower risk, larger producers. Okay, moving on now. Copper eased back again, and if you're wondering why copper gets a Guernsey in this update, it's because it's such a good barometer of world economic activity, and the fact that copper, despite the factual evidence that we were going to have a supply and demand deficit in 2018 going forward, and I still believe that is the case because you just can't ramp new mines and new production up quickly enough. The weakness in copper that we've seen all year, despite plunging inventories and despite a supply deficit, it was really an accurate indication that the global economy was going to slow. And so, once again, market action has got it right. Now, crude oil, West Texas Intermediate crude, we got a partial recovery. We got down to 45. We bounced back to 48. May settle somewhere around about this 50 level. It was deeply oversold and reversing, and we're starting to see a bit of an improvement in some of the stocks. So I'll just show you. Let's just look at XLE, which is the main energy sector ETF in America. This is on a weekly chart. You can see we peaked out here in 2014 at around 90. We dropped to 45 by January 2016. It's really been quite a roller coaster, but we've had another deep plunge in the energy sector, but then a big reversal over the last 2 weeks. So hopefully we'll see a bit of a rebound in that sector. There's the spot copper chart. Got down to 260 before bouncing a little bit. Inventories haven't really improved or changed much in the last month or so. And there's crude oil. We got down under 45, but we've now bounced back to 48. So to wrap all this up, this is absolutely no time to be clinging to preconceived ideas about certain stocks, about how you do things. I think you just need to have a very open mind, and I've been highlighting that for many, many months now. We need to work with just what's in front of us, stay neutral in outlook, and just go with what the market is offering. From my perspective, and you know that my fundamental orientation is bullish, but I try and not let that get in the way of what's in front of me. So I now have to acknowledge that the long-term trend is now in question. But at this stage, it could still be a replay of 2015-16, as I showed you. We could bounce around here, just go up and down in a very volatile fashion for the next 6 or 12 months. So I think it's premature to call this a major bear market. But the other point that I would make is that you've got to distinguish between what the index is doing and what most stocks that you're interested in are doing. I know that most stocks that I'm tracking in America are actually down by more than 20% off their peak. So they're in a bear market, despite the fact that the S&P is down about 18%, not quite in a bear market. Yeah, certainly a lot of individual stocks are. I think it's important to have a degree of diversification, but not in the normal way. You know, diversification across sectors just for the sake of it, to me, is just a really dumb idea. I'm talking about diversification where you have a spread of assets that are all really attractive in their own right. So they've got to stand on their own merit and diversify around based on that, but not just diversification across, you know, all stocks in the market, because I just think it's just not a very smart thing to have stocks in your portfolio that you know are underperformers just because they make up part of the index. I just don't see the sense in that at all. But certainly some degree of diversification to, you know, give you a bit of a shield against this volatility, I think is a good idea. Certainly your methodology has to be suited to this very high volatility, because I think it's reasonable to assume that it's going to continue. There's too many trigger points out there. Computer algorithms are having such an impact these days that I think we're going to see more of this volatility. And you're going to see, Trump is going to be under increasing pressure now that the Democrats have got partial control. I think the impeachment things are probably going to be ramped up. Trump will respond. You've got the trade war with China, where Trump will probably try and beat his chest there to gain votes. The Mexican wall issue, the government shutdown. I think you're going to see Trump increasingly do things that make people take notice, and that's going to lead to volatility in the market. So I think your methodology needs to acknowledge that that's going to be the case. Portfolio analyst this week is it's just about finding opportunities, and they're everywhere. I'm really excited about 2019. A little cautious on the entry, but I just got an absolute suitcase full of the world's best assets that are trading at bargain basement prices. Not sure that they won't go a little bit lower first, but tremendous opportunities from my perspective. Here are some positives. Now, I don't normally do this in this free video. I normally reserve this sort of stuff for members, but just a bit of an indication just to give you a perspective on where you might be able to look. So the things that I'm looking for and have been looking for quite some time is where there is limited downside based on fundamentals and valuation. So stocks have got to a point that, by any common sense analysis, they're probably not going to go down too much further. But as we all know, just because the fundamentals and the value is right doesn't stop prices falling further. So we also need to be mindful of where they sit technically. So I'm looking for stocks that are oversold on a weekly chart, which takes a fair bit of doing. Price has got to go down a fair way to reach oversold on a weekly chart. And yet these stocks still offer strong medium to longer term upside, and I'm talking 6 to 12 months. And so that's where I'm fishing. And when I look at all of the opportunities and the methodologies that could be employed, it's very difficult to go past writing covered call premium in a highly volatile market that net may go nowhere. So it's just going to go up and down in big, wide, violent swings. Absolutely perfect conditions for writing covered call premium against the best assets on the planet that have just been sold off very sharply. And there's a whole raft of them. They include stocks like ExxonMobil in the energy sector, Intel in the technology sector, Johnson & Johnson in healthcare and consumer staples. And uranium, I believe, has a really strong long-term future. It's been in the doldrums for about 6 years, but I think the outlook for uranium from here just continues to get better and better. And Cameco is the world's leading uranium miner. So they're just a couple of examples of stocks that fit this category. Now, would I go out and just buy the stocks on their own at the moment? No, I probably wouldn't, because I don't have a great deal of confidence that they're actually going to go up. I have a reasonable degree of confidence that the downside is going to be quite limited from here. But I don't have a great deal of confidence that they're actually going to go up to any meaningful extent. And that's why writing covered calls, it just makes perfect sense to me. And you can readily get 3% plus for 30 days writing covered calls. So if you can keep the meter ticking over very, very well with that sort of strategy. Now, if you've never done covered call writing in the past, it's more conservative than just buying stocks. If you don't understand it or you don't want to understand it, then I can help you with that. I've got a service that can help execute that for you. So if that's the case, then talk to me about that. The other area, of course, that I've been pursuing throughout 2018, it's not doing anything at the moment because during times of high volatility, small cap stocks just get belted. There's no liquidity. They just decline on very low volumes, and there's really just no support, no interest. But nevertheless, those businesses are still progressing. Those businesses are still doing brilliantly well. And at some point, the market will pick up on that and reward these stocks. So there's a whole bunch of Australian microcaps that are supported by very, very powerful secular long-term trends. They've got a very strong platform for growth. And I think at some stage in the next 6 to 12 months, we're going to get some amazing payoffs in some of these stocks. And you can, you see 300 to 500% to 1,000% gains in some of these stocks. A stock that might be trading at 15 cents now, in a year's time, could be somewhere between 50 cents and $1. So there's some tremendous stories in that space as well. So they're the two major areas that I'm looking for positives at the moment, and there's lots of them. There's my contact details. As I said, I'm a little cautious at the moment on the entry, but I'm extremely excited about the opportunities because we're now getting a crack at stocks far, far cheaper than what has been the case for several years. So that's it for this week. Welcome to financial the financial activities of 2019, and I'll be back with you next Sunday. Cheers.